this life ain't fair. And I know that you're going nowhere. Well, don't blame me for what you've done, because I know that you are having fun.
Welcome to the Clarified Realty Podcast, exposing the real estate secrets your agent doesn't want you to know. Here's your host, Tom Clary.
Well, don't you just walk away. That's when I'll say.
Welcome to the Clarified Realty Podcast. I'm Tom Clary, real estate agent licensed here in my home sweet home of Los Angeles, California. Thanks again for coming back. We always appreciate it. Also, here's my sidekick / loan officer, Ron Bruno. Ron, how you doing today?
I'm doing great, Tom. How about yourself?
Oh, fantastic. Feeling very, very good. Now, usually we have a little bit of news from my good friend Ron here, but this is sort of a very special episode, and we have a lot of content to cover, so I want to get right to it. Today's topic is something that is very close to my heart, and we've got two incredible guests that have some really helpful information for you. My guests today are Steve Landsman and Vahan Papyan from the accounting firm of Squar Milner. I've had the privilege of breaking bread with these guys and really getting to know them, and I seriously mean it when I say they really know what the heck they're talking about, and I've been nothing but impressed by their professionalism and the value that they provide to their clients. So it's really an honor and awesome that you guys could come by the podcast today. So Steve, Vahan, nice. I'm so glad to have you here.
Thanks for having us.
Thank you. So Steve, why don't you briefly kind of go into what your background is, what you do, basically.
Thank you. My name is Steve Landsman. I'm a partner with the CPA firm of Squar Milner. Our firm is a large CPA firm. We're one of the top 60 or so in the country, and we're in the top 1 or 2 of Southern California-based CPA firms, which means we're heavily invested in real estate, both as a tax and accounting endeavor for people. It seems like if you own a home in California, you're a millionaire.
Yeah.
So we like to provide services to our clients to help them acquire, maintain, and divest ownership in real estate.
Great.
From their single-family residences, first-time home buyers, to multifamily and commercial properties.
Great. Vahan, what about your background?
I'm a tax manager here at Squar Milner's Encino office. And as Steve mentioned, we know a lot about real estate and related taxation. And our goal is to help our clients be their trusted advisors and help them out in the process.
Great. And like I've said, I wholeheartedly trust in these guys' talents, and I'm really excited about this, what we've got ahead of you. Before we get started, I sort of want to frame up for everybody what the topic is going to be today. Today is an episode that has a very personal side for me. Before I entered the vast wasteland that is the real estate business, I was a visual effects producer for film and TV. If anybody's interested, you can check out my credits on IMDb. You might notice a flick or two that you may have seen, I swear. But I had always had a love for real estate. I actually got my license while I was still producing. That's how much real estate meant to me. But it was also during that time that my wife and I, we tried to buy a house, and there was just one big problem. I was having a real problem getting approved for a loan because I was a freelancer. I would work on a project for 9 months a year, and then move on to the next one. Basically, the nature of the film business is that you go from job to job to job, movie to movie to movie, and it was incredibly hard for me to establish a work history, something that lenders could look at and say, "Oh yeah, he's stable, he's okay. We'll give him money." I had worked on 3 Academy Award-winning movies, for God's sake, and I still couldn't get a lender to take a chance on me. But luckily, I was finally able to get the job done. But it was a real pain point until we got it all worked out. So, unfortunately at the time, I didn't have a great team around me like these guys. I was educated, but I didn't, quote unquote, know anything about how to overcome this issue. So now, later on in life, when I've put the glitter of Tinseltown, all the premieres and awards ceremonies behind me, I thought it would be a good idea to bring a team together that really specializes and focuses on folks in the same position, people who are freelancers, people who are self-employed, et cetera. So to show how they they can avoid all the common obstacles that are put in their way when they have plenty of income, plenty of time spent employed, but still can't get approved to buy a house. And that's where these guys come in. They're experts on this. They really know how to get the job done, and that's what we're talking about today. So thanks again so much for coming. So let's kind of just let's start off at the very, very beginning. When you have a client basically walk into your offices and say, I want to buy a house, but I'm a freelancer. How do you, as accountants, approach and strategize that plan?
It's interesting, Tom, because you can get consumer credit so easily. It seems that if you have a mailbox, you can get thousands of dollars of student credit.
Sometimes not even that.
Credit or student loan credit.
Right.
And for real estate in the climate since the late 2000s, it's been tougher. With the financial meltdown, it's very, very difficult to get a loan, and it's more difficult to get a loan at a good rate,
right,
with good terms. So we assist clients in that. We have clients that are foreigners, clients that are just entering the job market, and clients that are maybe coming out of a marriage or other backgrounds where it's hard to document and prove income. A lender is looking for cash flow so they can be repaid.
Yeah.
We all know that one bad loan can wipe out dozens and dozens and dozens of good loans. If you look at an interest rate at 3%, and if that loan goes bad, how many other 3% loans have to go well for a lender to even break even?
Right.
And lenders are not interested in breaking even. They want to make profits. So we want to position our clients to have tax returns and financial trails that are traceable and that make sense. Unfortunately, when you're earning income, to give a lender confidence, a lot of times there's a tax that has to be paid, and that's just the way it works.
Right.
So part of our job is to educate our clients, support our clients, and position them well. And as you mentioned, Tom, in your experience, for those that are not receiving regular W-2s, for those that are self-employed, or even getting partnership or S corporation income, which we call pass-through income, it's more difficult.
Right.
So typically, a couple years of good tax returns will position somebody to get a good loan. In addition to that, a down payment helps of at least 20%. It's sort of a gateway. Think of yourself trying to get into those clubs, and for waiting in line all night in the rain versus being in the VIP line,
Right.
we want to get you in the VIP line.
Got it.
So the start with is, do you have copies of 1099s? Do you have copies of other financial information? Are you organized? Can we put that together and then go to somebody like Ron, say, look, Ron, here's their recent history. Can you get us some information on their credit score, and can you get them a loan? This happens over and over again with single people, with non-married couples, and also with married couples. And the pride of home ownership, the tax-favored status of having a real estate deduction, and the ability to have total growth are what people are after. By total growth, you get the tax savings, and you get the increase in real estate appreciation.
Right. And we'll go a little bit more into depth a little bit later on in the podcast about that. So I want to hold off on that for just a second. But I'm going to throw this now to Ron. So Ron, we've now chatted with Steve about how he strategizes in order to get these people who have a tougher time getting into the loan. I mean, then they come to you. What is it on the lender side that basically can help them out?
Being prepared. And we've talked about this on previous podcasts, but the biggest thing is understanding, number one, Steve mentioned it, we're looking for cash flow, and we're looking for consistency of income. So if you are self-employed, that's completely fine. And what we're looking at is we're going to go back 2 years, and we're going to average that income if your income is going up. If your income is going down, then we're actually going to take that the previous year, which is lower, and that's the income that we qualify for. So having the conversation with your CPA early in the process helps, because they can then look at it and say, okay, you're going to buy a $500,000 home, but you're only showing $5,000 net income on your Schedule C. Well, that's not going to happen, right? So how are we going to put you in that right position? So I just had this pop up with a potential client where they were pre-approved with another lender, and they went in, they looked at the tax returns, they looked at the pay stubs, and sure enough, I went in and I looked at the tax returns, I ran their credit, and going off of their income, they didn't make it. However, 2016 is a whole nother year, and we're at the end of it. So he may be able to qualify next year. So being able to have those conversations before you file your taxes,
right.
That's when we can work together. And that's when the lender and the CPA, we can work together to achieve the objectives, because the CPA's goal in the whole world is to minimize the tax liability.
Right.
We're trying as lenders to show as much income to qualify.
Right.
So
They can
we need to get on the
definitely be
same
working
page.
counter to each other, exactly.
That's right. So we need to work on the same page for the client and their overall objectives.
Right. So before we even kind of go deeper into this whole process, why don't we kind of briefly chat about, look, I know that when I was feeling the frustration back then, I mean, there was the part of it that I was literally like, I don't even want to deal with this. Or I literally want to throw up my hands and say, okay, enough, I'm not. And, at that point, really the option is renting. You know what I mean? Because if you're going to, if you can't get into a home because you can't qualify for a loan, it's complete. The frustration is the only word I can come up with. But there are real positives about potentially purchasing a home. Like, why don't you go into kind of, Steve, why don't you kind of discuss some of the, just by purchasing a home, how it helps you on your taxes?
Thanks, Tom. Home ownership is something really special, and for the person in the right stage of their life, it's wonderful. It gives them a home, not a rental. It's their home. They can do whatever they want with it, decorate the way they want. They can park what they want in their garage, and there's security financially in home ownership. And when you own a home, most people never want to go back to renting again. So in home ownership, to acquire a property, you want to be stable in your life. Real estate is basically an illiquid investment, and usually the seller pays the transaction costs on a transaction. So if you're going to go in, you should go in because it's the right time of your life, not to try and make a quick dollar.
Right.
You can make a quick dollar. We've all heard about flips, and for those of us in the profession, we've seen flips that flopped.
Of course.
In other words, there are so many outside considerations that an individual has no control over.
Right.
Prices can stay flat for long periods of time. They can go down steeply and quickly during adverse conditions.
Right.
For those of you that are around in the riots and the mudslides and earthquakes, those three events all happened within a short period of time, and prices were down. And then we saw with the financial recession. Fortunately, here in Southern California, prices do rebound.
Yeah.
And
definitely. And let me just interject here really quickly. And one of the things that I keep on kind of reflecting back on is because I did go through the pain of getting my own home, and I actually happened to do it when we were in the middle of the crash. We were actually mid-crash, right? So I jumped just as the ground was falling out from underneath everyone. But luckily, I kept my head about me, basically. A lot of people didn't, and a lot of people saw the values just crashing and said, I got to hit the parachute and jump. There's a power to holding. So my house still kept on going down with everybody else. But now, today, because I'm in Southern California, where there is still a scarcity and there's still, people want to live here, my home value has gone back up, and I've done extremely well for it. So there's a power to holding.
There sure is. Globally, people see Southern California as a first world area with third world prices still. We've seen what's happened in Vancouver,
oh my God, yeah,
Manhattan, London. And it's happening here too. We have a lot of foreign investors that come and buy single-family homes, and they hold it for investment.
Right.
So you're absolutely correct. For those of us just entering the home market, I'll let Vahan speak. He entered a few years ago. It's a challenge. It's exciting, and we're here, as Vahan mentioned, as your trusted advisors, to guide you through the process and to help you avoid the bumps. And what are the bumps? The bumps are lying on a loan application. You're going to sign a document that gives the lender the authority and ability to go to the IRS and get a copy of your tax returns. So if you submit a fraudulent tax return, not only is that a crime, you're likely to be caught.
It's going to hurt.
and with the electronic information available today, those things are hard to shake from your past. The other issue is getting the loan that's right for you. We know people that have interest-only loans, and there's people that get P&I loans. There's 15 years now. There's 30 years now. It's a great time to buy now, given the stability in Southern California. There's a lot more industry here. There's more people coming every year, and interest rates are still at historically low levels.
Right.
Vahan, can you tell us what it was like for you entering the home ownership when you did a few years ago?
Yes, of course. Buying a house is something that most of us do once or a few times in our lifetime. It is really a major event, and especially the first time, it's very exciting. I got into the market when everything was going up after the crisis, and it was going up quickly, and there were a ton of buyers for every property that's out in the market.
Right.
So it's not easy to just go and, hey, I like this house, I want to buy it. You really need to approach it properly. And I want to go back and reinforce the fact that you really need to have a great team helping you. The real estate agent has a major role in helping you go through that process and beating it right. And Tom, you're great with that.
Thank you.
And the loan officer, Ron, is great at helping with the loan process. So with the right team, you can get into it with the correct preparation.
And let me just kind of pause for just one moment. We talk about how important the team is, and building that kind of those guides that guide you all the way through, the process. But it's also about setting up your pipeline correctly in terms of getting one foot in front of the other, making sure that you guys come to your financial advisor first to really understand whether or not you're in a place where you can even do this, to talk to your accountant to kind of set you up tax-wise, so that when you go and get the pre-approval from Ron, it's a process. It's literally a pipeline that leads to me, basically, and making sure you're not getting the cart before the horse, basically. Exactly. Right. So you were going to say, though, I'm sorry, did I interrupt you?
No.
Okay. Yeah. So, but now, just so we can briefly kind of go into the kind of under the hood here, what are the explain to the audience what the deductions are that they get from having a home, from purchasing a home?
From purchasing a home, you're going to get an interest expense deduction on your mortgage, which has certain limitations. Currently, under the tax code, your limitations are subject to $1.1 million of real estate debt. And the other deduction you're going to get is for your real estate taxes paid. And once the home is purchased, you can adjust your withholdings or your estimated quarterly payments to have greater cash flow. Because once you buy a home, you're now going to have homeowner's insurance. You can have utilities, where, as in an apartment building, you may have had renter's insurance, you may not have, but it would be a lot less, and you would have not had to pay for all the utilities. So you're going to have some additional expenses, but the deductions clearly outweigh those additional expenses.
Right.
So in most situations, your taxes will go down substantially.
Right. Now, one of the things we talked about on a previous podcast was doing a 80-10-10, basically, where you, and Ron, you can go into this a little bit more depth, where basically you could work it out so that instead of paying your mortgage insurance month to month to month and not being able to write that off, you could go ahead and talk about that a little bit more. You can actually do it as a HELOC, but go ahead and talk about that a little bit.
Right, exactly. So let's say the home is worth $500,000 and you only have $50,000 to put down. You only have 10% to put down. So instead of having to pay mortgage insurance on that loan, what you can do is you can have it where the first loan is $400,000, right? So that loan is going to be at 80 loan to value, and then you can set up a HELOC for the second part of the loan that covers, you only have 10% put down, right? So that the other 10% is a HELOC. So now your loan to value is
A home
90.
equity line of credit, by the way, just to remind
Correct,
everybody.
right? Home equity line of credit. So now you don't have mortgage insurance because your first loan is at 80 loan to value. You have a home equity line of credit for the other 10, and you still are able to finance it with 10% down.
And it is possible for a HELOC to be written off, correct, or no?
That's correct, Tom.
Yeah. So that's another way that you can take advantage of, another deduction, basically.
Correct. And the government encourages home ownership. They believe it brings stability to communities and to families.
Right.
And that's why these expenses, no matter what the political climate is, these expenses are deductible. Right. And it really would be revolutionary if the government changed the policy on that.
Right.
And with conventional loans, just something to add, and I'm just sharing with the whole group here is, I have a client that I was talking to last night at 9:30 at night, and we were going over all the options, right? So we were looking at all the various options, and one of the questions was, okay, do I want to put, they have 10 or 15% to put down, right?
Right.
Obviously, there's going to be mortgage insurance associated with that.
Right.
And because the rate was pretty manageable, I looked at lender-paid mortgage insurance. And the reason why I looked at lender-paid mortgage insurance, or LPMI, is because, sure, you're going to be paying more in terms of your monthly payment because your rate's going to be higher. However, it also means you can write off more of the interest.
Right.
Right? So mortgage insurance is not, and correct me if I'm wrong, but mortgage insurance is not tax deductible.
The government's policy has gone back and forth over the years. It can be deductible in certain years under certain circumstances with certain limitations.
Okay, so here's another thing that I wanted to briefly kind of get into. So one of the things that is a positive effect on potentially buying a house, I should say, is that if you're not itemizing your deductions before that, it could literally pop you into a cascade of basically itemizing and deductions. Isn't that correct?
That's absolutely correct, Tom. And to explain it without the audience's eyes glazing over.
Well, they do that anyway, Steve, but that has nothing at all to do with anything.
You have a standard exemption, and if you're Schedule A or itemized deductions, those are the deductions that appear on Schedule A, sum to less than the base amount, which changes every year, you're not entitled to those deductions. Some of those deductions could be medical, they could be charitable, they could be employee business expenses, and then smaller ones might be safety deposit boxes fees or tax preparation fees. But the interest expense and real estate expense deductions will get you over that threshold, and now all these new deductions will add to that sum,
Right.
which will lower your adjusted gross income,
Right.
and lower your taxable income.
So
you're
another
absolutely
positive
right.
effect.
It sure is. It's sort of like a sled where all these other deductions can hop on and,
Right.
and get through the tax return and lower your tax liability.
Right. So what I'm really trying to do is look, there's lots of fears that drive you. Fear of going through this process and being denied, going through and finding out that no, it can't. But there are also some fantastic gifts on the other side of that if you do it right.
Well, and exactly. That's where I was going with your life will be different. You're not going to ever want to be in an apartment building
Right.
again. And it's really a major step in life. As Vahan mentioned, real estate is usually someone's largest asset and their most meaningful asset. You open the show by saying home sweet home.
Yeah.
I've never heard anybody hum that to themselves going into an apartment building.
Absolutely. No, it's true. So when you're planning with one of your clients, realistically, do you guys have an opinion one way or another about basically how much someone should be spending on housing? Like is there any kind of a good ratio that you think about?
For financial matters and tax matters, the answer is always, it depends.
Yeah.
And that's a very frustrating answer to a lot of people.
Right.
But we are almost like doctors at a large hospital where we see a great number of situations. I come from a firm that was involved a lot in marital dissolution. So you see a lot of hardships in life. And in the area of accounting we work in, we see a lot of success stories. So it depends on where a person is on that curve and what is most important to them. I think that the adage of location, location, location still holds true. And the more money you spend, the better neighborhood you're going to be in. the better school district you might be in. So it depends. Are we talking about a childless couple? Are we talking about an older couple? Are we talking about a young person with a good income that wants to enter the real estate market? And the answer always varies.
Right.
But no matter the circumstance, real estate ownership nearly always works out well if you are never forced to sell.
Right.
Just like owning a security, if you're never forced to sell and you are able to choose the time to sell, that's the best position to be in.
Right. I just want to take a little brief kind of step backwards since we're talking specifically about freelancers. All right, Vahan or Steve, I was talking about some of the different positives about home ownership. So if for freelancers, do they have any kind of extra benefits if they are, things that they can deduct that maybe others can't think about doing, or?
Yeah, if they're using their home for business, they have a home office, an area in a home that they regularly are using for their business.
I'm going to pause right there. Are there guidelines about a home? I've always heard about a home office. Are there any rules that you have to have, or can it just be a room, or what's?
Yeah, there are rooms. You have to, I think, exclusively and regularly use that specific area for your business. And then, so if you do that, then you can take a ratio of your home expenses, and the ratio would be the square footage of your home office over the total square footage. And that way you get to deduct that portion of your utilities, insurance or repairs and maintenance. And if you make direct improvements or changes to that specific office area, then those would be direct expenses, and you could actually deduct more than the ratio.
One of the neat things about home ownership is if you can do that also in an apartment, but most people in apartment buildings don't have an extra room that's exclusive.
Right.
And for people in the entertainment industry or freelancers, they may use their backyard, they may use their garage, and that gives them more opportunities in the home to garner these deductions, which also reduce the self-employment tax. For freelancers, there's the income tax. For some, there's the alternative minimum tax. And for all, there's the self-employment tax. And whatever expenses are direct expenses, even if they're the direct indirect portion of the house, in other words, like Vahan said, the area is used exclusively for business, those expenses will reduce the self-employment tax, which is significant.
Got it. So let's move a little bit more into what we can do to help the freelancer and self-employed person actually get the loan. Okay, really, what kind of helps them break through the walls that are kind of put up in front of them. And let me just kind of start off with, do freelancers gain anything, or self-employed people gain anything by either incorporating when it comes to buying a house? Like, is there anything that helps them by incorporating?
That's a great and a little bit of a tricky question. If a lender sees, and we'll ask Ron this, someone who's incorporated, that shows more stability, more professionalism, but also has a little bit of complexity because they're looking at a corporation tax return and also a individual tax return. And so it's up to us, and really more Ron, to explain to the ultimate loan provider how the income and how the revenues occur and pass through these two tax returns. So for tax purposes, there's a lot of reasons to incorporate.
And what I would say when it comes to, do I incorporate because I want to get a loan? You don't incorporate because you want to get a loan, right? You incorporate because you want to create a safeguard in terms of your liability. You want to be able to take certain deductions that you wouldn't have before. So what I look at is not when I talk to somebody, I don't say, okay, you know what, I really think you should incorporate. That's not the discussion.
Right.
It's because what we're looking at is a snapshot in time. We're looking at what you did 2 years ago, right?
Right.
So if if the answer is, okay, I want to incorporate because I want to get a loan. Well, okay, we're going to get a loan in 3 years, right? Possibly. So what I'm looking at is there's kind of 3 ways I would say where majority of freelancers fall in, right? So number 1 is we're looking at someone who earns W-2s. So you probably had W-2s, right?
Right. Yeah.
So
and some 1099s.
And some 1099s. Yeah. So that means that you're going from gig to gig, and maybe from January to March, you're on one project and you get a W-2 from the studio. Then in April, you get a gig for 2 months, and then towards the end of the year, now you get 2 more jobs, and so there's not necessarily that ongoing pay flow.
A general there's nobody getting a gold watch in the film industry. You know what I mean? Nobody's working for 65 years and then retiring. From one job. It happens so rarely as to be almost not even.
So you're going project to project, and you have a collection of these W-2s and 1099s. So if you are not a sole proprietor, you are just earning wages, you can report that as wages on the first page of the tax return, right? And in the past, lenders would say, oh, wait, you're not currently on an assignment? I don't have a current pay stub? Well, you don't qualify.
Right.
However, there has been a recent change in the guidelines, and we had a client that was in the same situation where they had a history of receiving multiple W-2s and multiple 1099s, and they reported their income as wages on that first page of the tax return. And what we did was we averaged, because his income was almost exactly the same between year to year, and he actually did not have current, he wasn't on a current project because
he was on break.
He was on break looking for a home. Right. So, he was very concerned, and we discussed this in a previous podcast, but what is very important to know is in the past, he wouldn't qualify.
Right.
But now we're looking at the average of those 2 years, and we assign a value to what his income is because he has a history. Right. So freelancers, you have that opportunity where we can look at W-2 income and piece together a consistent history.
And I think this is incredibly important to kind of interject here, that back when I was, pounding my head against a wall, that was the situation. I literally had that problem, and we had to basically look completely at my wife in order to get qualified, basically. Luckily, she had something that was consistent and, was year to year to year to year to year. But, we qualified for a lot less because it was only her, right? Now, and there's like this myth out there in the, especially in the, film industry and with freelancers, that this wall still exists. That I'd love to have a house, but I'm this, that, and that. But there are now new things that basically help you to get out there and actually have the power to buy a house.
That's right. And so that's door number 1. Door number 2 are where you're reporting your income as a sole proprietor. Right. So you are self-employed, and you are reporting all of your gross income on Schedule C. Right. So Schedule C, sole proprietor.
Right.
So you have your gross earnings, and then you take all these deductions. Right. You have cost of goods sold. You have all these various deductions, and then you come out with a net earnings, right? So that net earnings, that's the number we use,
right?
A lot of people are thinking, oh, gross earnings, you're set, $100,000, great, that's the number we're gonna, wrong. No, we're gonna be using the net number, and then we can add back a couple things, right? So we can add back depreciation, we can add back depletion, we can add back mileage expense. So there's a couple little things that we can add back,
right?
But in general, we're looking at the net number plus whatever those add backs are, right? So it's important that if you're looking to buy a home and you're reporting on Schedule C, that you have enough income that we're showing, right? And then the final one is you are, I would say, more established. You're having a lot of income. You may even hire somebody, right? You could then set up an S corporation, right? And Vahan and Steve can talk about the specifics of an S corporation, but essentially,
and I will. That's the next thing we're going to be chatting about, and I do want to make sure that we get there because there are these different choices that you can make in terms of incorporation, S corp, C corp. Can you briefly kind of go into the different versions of that and what they help and what they hurt? And
you bet. Thanks, Tom, and thanks, Ron. I want to take a step back for what Ron was talking about.
Sure, go ahead.
And these days, a lot of times trends are important. So if you're not looking for a home in January or February when your W-2 is very fresh from the prior year, a lot of times lenders will want to see what's happening this year. I saw what happened in 2014, I saw in 2015, but now what's happening in 2016? The third quarter just ended.
Could tell a completely different story.
So as accountants, we can assist our clients put together a P&L where we can list the revenues and we can list the expenses. The lender may ask for bank statements. We'll have those. And we can show, if the trend is good, we can show the good. There's something else that we do at towards the end of the transaction before the loan is funded, and that's when the lender says, we want a CPA letter, Tom or Ron. Will your client CPA write a letter, and Vahan and I will write a letter to help you close the deal.
Got it.
Because that's no fun. In taking the next step in someone's career and in this conversation about entity formation.
Right, exactly, yeah.
So as you guys mentioned before, one of the primary reasons to create an entity is to limit your liability.
Right.
And kind of a neat thing is once you're in that home is an umbrella insurance policy, which for those of you that have been around LA and life of it a little bit longer, I think it was O.J. Simpson's umbrella policy that
covered his lawsuit.
Paid for his criminal defense. Umbrella policies are sort of that shield that we see in cartoons that immunize people.
And we'll go into those a bit more when we're going to have an insurance specialist on as well, and I'm sure that's something we're going to be covering. But absolutely, the one of the things that I think that people they kind of get themselves kind of stuck into thinking of using a corporation as like some way to save money or whatever, but it's really about protecting, like keeping a shield between you and somebody who's trying to sue you, basically, because then they're suing the company, not you personally.
Right, and without sounding like an Alfred Hitchcock movie description, as long as you treat the corporation like a corporation and there's no alter egos involved, where you and the corporation are inseparable, that shield usually holds up under California law for liability. Now, the other reasons you guys also mentioned were there are tax savings because you can deduct items in a corporation in a different way. And this is particularly true for those in entertainment that pay agents and attorneys percentages. If you pay them a percentage and your income is a W-2 income, the likelihood of getting that tax benefit is reduced.
Right.
The other reason may be greater retirement plan savings. But we're talking to someone that's trying to qualify for a loan. They may be younger or newer. Like in everything else, if you've had a home loan and you've made timely payments, your chances of getting the next home loan are greater. So the entities that we see most often for individuals are S corporations. Currently under the tax law, there's favorable tax attributes associated with them. They get the liability protection. You can make greater retirement plan contributions, and you can realize better tax efficiencies through the ability to deduct more expenses. And there's also, and with a good return, it won't matter, a well-prepared return, but the likelihood of being audited when you have an S corporation versus Schedule C is less.
Interesting.
It just is.
Well.
So those are primary reasons why we see clients with S corporations or why we would recommend an S corporation.
Is there any thinking behind that? What's the thinking behind why that would be more of why it's less likely?
There's probably a couple reasons, and these are just my own perceptions.
Unscientific.
One is, and if someone's going to go to the trouble of incorporating, they're probably a little bit more serious about what they do.
Right.
And it's less likely to be a hobby.
Right.
So for people that are do-it-yourselfers or fly airplanes or collect stamps, they try and move those. The classic ones are racehorses or farming. That people have where they try and get a tax deduction for really which is a hobby or a non-business enterprise.
Right. And by the way, and this is something that I think that I've heard you have talk about before. There's a price to having a corporation every single year, and that if you're just a hobbyist, I think it's $800 a year.
You're exactly correct. There's a minimum California franchise tax of $800 per year.
Why would you even do that? If
sure.
It's just,
and then you're going to have a separate bank account. You're going to need another tax return prepared. So I think people oftentimes try and load in expenses on a Schedule C, which Ron mentioned is a sole proprietorship. Now, depending on what a person does for a living, they might have an S corporation, but there's also many instances where a person might have what we call a single member LLC, which is a disregarded entity for federal tax purposes. That's a mouthful, so I'm going to ask Vahan to illustrate where somebody might have an LLC as opposed to an S corporation. And in a lot of instances, a person could have either.
Look, why don't you go into Vahan? Why don't you go into that a little bit more in depth? What do you?
Yeah, there's a difference in how income and expenses are reported for single-member LLCs versus S corporations. Single-member LLC is really disregarded for federal income tax purposes, so it doesn't really have a separate tax return for federal purposes. It does have a small, kind of limited short version of a return to be filed with California, where you pay the $800 minimum tax, and then there's also LLC fees if you have gross receipts over certain thresholds. Over $250,000, it starts at $900 and can go as high as $12,000 in LLC fees if your gross receipts are over $5 million. But the income and expenses actually are reported on your Schedule C, on your personal individual tax return.
Right.
So again, it looks like a sole proprietorship.
Right.
Just almost as if you just had a DBA and you were just acting as a.
But you are still getting some sort of protection there,
yes,
though.
you still have the protection, assuming you keep things separate.
Right.
And have a separate business account.
Because my wife is an attorney, I know the actual term is called piercing the corporate veil. And it's basically, you need to make sure that you're keeping your peanut butter from your chocolate, basically. If you got to make sure that, if for whatever reason you get sued later on down the line and you're a corporation, if it looks like you're just using that corporation as your personal ATM, it's very easy to quote unquote pierce the corporate veil. And that's kind of what we're talking about in terms of protecting you from the liability, correct?
That certainly is correct. And again, going towards the first-time home buyer, they're more likely to have a Schedule C if they've been incrementally advancing their careers. If you have somebody out of an art school who becomes a director pretty quickly and has sophisticated mentors or people in their lives, they can point them to establishing a corporation that may occur as well. But we're talking about people that have Schedule Cs or receive 1099s and go from job to job, and they're not itinerant in real life, but to a lender, they may look a little bit itinerant.
Right, because it's not like you're switching jobs because, I don't feel like being there anymore. They told me that I can't, that boss told me that I was 5 minutes late on my coffee break. I'm quitting, I'm going to the next one. It's not that at all. It's like literally your project ended and it's time to take you to the next one.
And that's the case more now than I think ever because of the high cost of having employees.
Yeah.
It's always a cat and mouse game where the government wants to push people into employee status to get the payroll taxes.
Right.
But there's so much more content demand now where there's so many more productions that are almost like pop-up productions and pop-up channels and pop-up this and pop-up that.
Right.
So for people to stay gainfully working, they have lots of different revenue sources. So it's our job and Ron's job to create, I don't want to say create, but to express the story that's really happening in financial terms that a lender understands, accepts.
Right.
And wants to go ahead and make the loan.
Go ahead, Ron.
So I want to get back just to one. So when we were talking about the various documents with an S corp, so one of the advantages with an S corp is you can actually pay yourself. Right? So you can actually pay yourself a salary, and we can use that to qualify the income. On top of that, you receive after you have filled out an 1120S, right? So that's the business tax return for an S corp. You will actually have a document that's called a K1, right? So a K1 is a reflection where it'll actually show retained earnings, right? So it'll be essentially your net, and we're able to use that number to combine that with if you pay yourself, and that's how we calculate the income. So it's actually potentially a better vehicle where you're able to qualify for more.
Yeah. Steve, you want to
I'm sorry, Ron. Yeah, let me step in. The 1120S will have the retained earnings on it, and that's going to almost be like a piggy bank for the lender, that and the cash balance on the balance sheet. The K1 is the form that includes your tax attributes of the corporate activity. It'll have the pass-through income.
Right.
It may have Section 179. accelerated depreciation expenses. It may have interest
Can you
income.
really briefly, what is that? So people can understand that.
Sure thing, Tom. The government, no matter who's elected or what party or what election cycle, elected officials, I think, there may be more cynical people out there, but they really try and do improve lives for their constituents and really for all citizens. And they use the tax code as a tool to do this. So the taxes are always changing, and Section 179 was instituted a number of years ago, whereby a small business, or really any business, could expense in the year of acquisition a fixed asset. So a fixed asset is something that'll generally cost over $500 or $1,000 and will last longer than a year.
Like a nice big computer or something like that, right?
A nice big computer or a big piece of equipment.
Sure.
So we have a lot of clients who buy pieces of equipment that cost hundreds and hundreds of thousands of dollars, and the government will let them expense that cost in 1 year for federal purposes. California is always different than the federal, and their deductions are limited.
Yeah.
So these rules are always changing, but a Form K-1 will indicate to the lender what is a one-time expense. So if the income is lower, we point and say, well, we bought a new piece of equipment and the income will be higher again next year. And that also goes to what Ron mentioned as a depreciation add back to income. So with a sophisticated person like Vahan or like Ron, they're going to tell the story that's favorable to you and true.
Right. Right. Let me take a little kind of side trip here into down payments and gifts that you can get from family members. We've discussed that on previous podcasts, but I'm curious about in terms of the income tax impact on either giving or receiving gifts. Do you guys have when someone like gives their kid $50,000 so that they can have a down payment or whatever? What is it? What do they have to declare it? What happens with that?
The rule is every year each person can give to another person $14,000, and that could be if you have two parents, have two kids.
$14,000.
Each give $14,000 to each kid.
Got it.
If they give more, that's fine. It's not taxable. They just need to file a gift tax return and show the gift. And the reason to this, and when I'm saying it's not taxable, it's in the case where each person gets an exclusion for their lifetime, and that exclusion now is about 5.4 million, and that changes. It used to be 1 million, 5.4. Hopefully, it will stay there and go up. And if you gift more than that, or if somebody has a big estate over that and they pass, then there is the estate tax, which is kind of the equivalent of the gift tax. While if the person is alive and they gift more than 5.4 million, then they have to pay gift tax.
Right.
However, if it's less than that, then there is no actual gift tax, but they still need to put the government on notice that they gave this gift.
Right. Now, but do the potential buyer, the receiver of that gift, do they have to declare that on their taxes or not?
No, there's no.
So even though it's a gift, it's not like they received revenue or anything like that.
Yes. If it's a foreign gift, there are some reporting requirements. If they get a gift of over, I think, $100,000, they may need to file a form.
Right.
But if it's within the U.S., if it's less than $14,000, there's no requirement to file. If it's more, for the receiver, again, there's no requirement.
Right.
For the gifter, they need to file a gift tax return.
Got it. Ron, in terms of, I know we've had a conversation in terms of gifting and seasoning and all that, but if you could just touch bases. And by the way, if there is, we've talked about where these sources can be, basically. Is there any issue in terms of like a foreign money coming in or someone from? Not really, right? I mean, if it's within the same guidelines,
it does depend. I mean, there's certain countries that only allow a certain amount of money to come in. So
right.
China is one example.
Right, and I've heard that they've been cutting back on a lot of the cash that's leaving China, basically.
Right, and there's others where if you have assets coming from certain countries that are on a watch list, right?
Right,
So,
right.
so if it's coming from Syria or if it's coming from Kuwait or whatever those countries are on the watch list, there's certain guidelines to follow from that standpoint. But as far as a gift, really what we're looking for is we want to have the trail, right? So we want to have the documentation. So if it is, and a gift can only be coming from a family member, right? So we talked about that before, but it's coming from parents, it's coming from grandparents, it's coming from step parents, brother, sister, or it could be looking at the kids giving to their parents, right? So those are all options that are available. Cousins, no, we talked about cousins. You can't have that. But the whole idea and the easiest way, and I think it's worth repeating, if you're in a transaction, if you have, let's say it is it's husband and wife, and one of the parents is going to give the gift. The easiest way to do that is fill out a gift letter, state the exact amount that they're going to be wiring to escrow, state the account it's coming from, and you're going to click a box that just says we're going to wire X amount, so $250,000, it's going to go directly to escrow, because what that's going to allow us to do is we don't have to go and look at bank statements from those parents, right? So if you have a wealthy family and the parents don't want to show all their assets, that's a great way to do it, right? It's just something that's very simple, clean. So,
Steve, did you want to interject something? It looked like you were trying to say something.
Yeah, I was thinking about the real life circumstances we deal with, and for a lot of people, it takes a village.
Yeah.
And you guys did a great job about explaining who could be in that village if you can't.
Right.
But let's take a newly married couple, and their parents have the ability to help them. So building on what Vahan said, for two people, they could each receive 14 plus 14 plus 14 plus 14, and what is that, about $56,000 as a gift. So for those in a calendar year, for those looking for a home now,
right,
if those parents could give 56 now and 56 on June 2nd, that's a down payment. They can really purchase a lot of homes, starter homes now.
Yeah.
But I wanted to ask Ron a question, because I was thinking back to some of the situations we're involved in, depending on the family dynamics. How, Ron, does a co-signer help? In other words, credit's not established, kids ran out on their utility bills in their last year of college like I did. Wait, I didn't. This isn't recorded, is it?
Yeah, right.
How does that help, Ron?
And it's right, we did. Actually, I don't think we covered that during our mortgage one. So let's go briefly.
I don't think we did.
Idea. Yeah.
I don't think we did. So what Steve's referring to, a co-signer or a non-occupying co-borrower, right? What that does is we're now adding another person to the loan, right? And what it allows is, so if someone has poor credit and and they're on the loan, we're still going to have to use their FICO because they're on the loan. But if there's someone who has, so let's say you have the husband and wife, and then you have a parent who is a vice president at some corporate company, and they're making tons of money, and they have supreme credit. Well, that is absolutely going to help, because what we're going to do is we're going to add them to the loan, and we're going to run their credit. We're going to count all their liabilities, and if they don't have a lot of monthly liabilities, then or they have enough cash or they have enough income to offset that, that's really going to help, right? And they certainly can give money as the down payment in that transaction, and you don't have to have a parent or a family member be a non-occupying co-borrower. It could be a friend, right? Now the friend can't give a gift, but they can be a cosigner, or they could be a non-occupying co-borrower.
Right.
And the whole idea of non-occupying means that you're not going to have the father-in-law move in. Right. So they're able to contribute, because what's going to happen is the father will then be on the loan, right? They don't have to be on title, but they will be on the loan, and it will be on their credit report, right? So if you don't want to upset your in-laws, make sure you're making those timely mortgage payments, because it will. It can.
It's going to impact. It will impact them if you decide to. Basically,
it certainly can. Now, let's say the father, he hit he was laid off or whatever, and he started his own business, and now he doesn't have as much income, and now he has, when people run that credit report, now it's showing that mortgage, and now he's in the position where he's like, oh man, with that mortgage, you're hitting me with the mortgage and the principal taxes, and the PITI, principal, interest, taxes, and insurance. So now I can't qualify for a home. Now, here's something that a lot of people don't think of. If you can show a history, typically 12 months, of the kids making successful mortgage payments on time, and the father is not tied to that, then an underwriter can excuse, they could possibly excuse that from the overall debt, right? So you're not locked in where you can never apply for a home loan if you're a cosigner or if you're a non-occupying co-borrower, as long as the primary people are making those bills on time and all that. So that's just something.
Another option.
There you go.
Something to think about. We're now needing to kind of pull the. We're coming into land here. We've had a really great conversation here, but I just have a couple more things I wanted to kind of bring up very quickly. Is it a foregone conclusion that someone who's a freelancer or self-employed, that they're going to have a higher interest rate?
No, not at all. Not at all. So we don't assign interest rates based on who you are or, race, religion, any of those things, right? So that is way out the door. That is not the case at all. So when it comes to determining interest rates, it is just simply a formula. So the biggest one is FICO, right? So we're looking at the FICO score. We're looking at the occupancy. We're looking at the type of property. We're looking at how much you're putting down, and we just assign the income. So the income can come from your pay stub, and you're working for XYZ company, and you're a director at that company. Okay, fine. You make $10,000 a month. That's the number we're going to use. You could have your own company, and you've had your company for 4 or 5 years, and we're averaging those too. It's just a number. It's
right.
Just a number. So now we're putting in $6,000, whatever that is, right? So there are thresholds when it comes to the debt to income ratio based on the particular lender we're going to be sending the particular file to. But no, there is no discrimination based on what your employment status is or any of those other items.
Great. All right. So we're going to be closing up here, and I just want to briefly kind of put it out to you guys' final comments in terms of what you guys would be looking for in terms of the, a freelancer walks in, anything strategy-wise that you think we haven't covered yet, or anything that you think that is going to help them get the edge in terms of getting into a house?
I think the two operative words for Vahan and I are organization and planning.
Right.
So we want your past couple of years to be well organized. So hopefully you have good tax returns. If we prepared the returns, you'll have them. We have excellent security and retention policies and programs, and we want you to be prepared to execute this loan. So what does that mean? That means that the lender is going to want to see an interim profit and loss schedule. We can help you prepare one. It's easy. And we're going to want you to be available to answer questions, because lenders often in the closing hours want additional documents.
So true.
Lenders have
absolutely so true.
Different hurdle rates to get through. So and Ron can elaborate more on this, but it's the lender, the salesperson type lender, then the loan committee, then getting that loan funded. And at each stop, it seems like they're going to ask for additional information. And we want our clients to either allow us to get that information for them or to provide that information to us. Usually loans have a certain term that they will lock in an interest rate. And it seems like every quarter we hear in the first or second month of that quarter that interest rates are going to go up in the next quarter. They haven't, but one time it's going to happen, and then they may go up rapidly. So we don't want to lose a lock period. And as I see the costs of fuel going up and oil going up, that's often a predictor of inflation to come.
Right.
So we want you to be organized and be prepared to go through this process, and it can be nerve-wracking. That's where professionals can give you the pathway that you're going to be going down, keep you sane, keep you calm, and most importantly, obtain success in you getting the best loan possible.
Got it. Vahan, any last thoughts?
Just be patient, work with your team,
Right.
and you'll get there.
Yeah. One step in front of another. I mean, really.
One other thing, Tom, there's a lot to do in real estate, conversion to rental properties, 1031 exchanges. Maybe in our next podcast, we'll cover some of those. But once a person has this asset, that's a pretty cool thing to have and a pretty powerful thing to have. They can leverage that. They can do a lot of things with it to then take the next step. Most people that buy a home, it's not that much longer until they have a second investment.
Right. No, it's so true. And what I always talk about on this podcast is, whenever I work with clients, one of the main things I want is for them to walk into the house, sit down and go, and when they have the most information, when they know tax-wise what's going to be, happening to them in terms of how they can use it to their advantages and how they can use taxes, in order to get into them in the first place. And of course, we've talked about with Ron about how financing works and all this. That only helps to alleviate that fear, that crippling fear that just stops people from actually taking the step and avoiding probably what is one of the most satisfying, for me, one of the most satisfying experiences of your life.
Sure, it provides some amount of security. If you may be in a rent-controlled apartment, you can get kicked out.
That's true.
If you're in an apartment, they can move you out. They convert to condominiums. They can sell the buildings. A lot can happen. You have a really bad neighbor.
Yeah.
And they're just 4 inches to the wall away, as opposed to if you have a bad neighbor in a single-family home, they're probably 20 feet away.
Ron, any other thoughts in terms of the freelance aspect of this whole thing?
Yeah, I would say the biggest thing is just to be organized and have a plan and have the right team in place. One of the pet peeves that I have, and I've seen, and Tom, I know you've seen this,
yes.
is you have those weak agents that call you at the last minute and say, "Oh my gosh, you got to pre-approve them," because you know what they care about? They care about their commission check, right? And that is not what it's all about. It's being thoughtful, it's being deliberate, it's coming up with a strategy and working with your team, and then being critical with your choice of property and getting what you want. That's what it's all about, right?
Absolutely.
That's what it's all about, and making sure that you have your team and they've done the due diligence and they've investigated all these various options, and there's really nothing you can think of in terms of what else the underwriter could possibly ask for, but you're ready to go. You're on call, you're on top of it, and you know that, and you're engaged. That is the biggest piece of it, and that's why I ask for a documentation up front before I issue the pre-approval letter. Because if you're not engaged and all you care about is that piece of paper, then I don't want to really talk to you.
Yeah, true.
Because you're not going to be responsive in the process, where you've got a timeline and you've got deadlines and you've got all the pressure and anxiety and everything going on in the middle of the transaction.
Right, and you don't even realize until you're deep into this how fast things move. I mean, that clock keeps ticking, and those milestones need to be hit. So the more you have your story ready to be told, the better you are at the very beginning. All right. Well, Vahan, Steve, Ron. Also Ron today, thank you so much. I do want to thank you for giving us a real strategy for how freelancers can overcome their infrequent work history and still purchase a home. Why don't you guys go ahead and give the folks the info where they can contact you. Why don't we start with Steve? Go ahead.
Thanks again, Tom, for hosting us today.
Absolutely.
We're located in Encino, California, at the intersection of Densmore and Ventura, or as I like to say, just west of the McDonald's at Haskell and Ventura. Sort of a landmark here. And as a
so
kid,
get your taxes done and a Big Mac.
Well, a lot of my friends work there. I'm born and raised in the Hollywood and East Valley area. So our number is 818-981-2600. Please give us a call, 818-981-2600. We'd love to speak to you on telephone or in person. And if you come to our offices, we'll validate.
Fantastic. And do you have an email that you can get contacted at?
Yes, thanks again. It's S for Steve, Landsman, and it's kind of funny with real estate, L-A-N-D, like the word land, S-M-A-N, at Squar, which is spelled S-Q-U-A-R. It's like square without the E.
Right.
Milner, MILNER.com.
Great. Vahan?
Thank you, Tom. My phone number is the same, 818-981-2600, and my email is V as in Victor, P as in Paul, A, P as in Paul, Y, A, N as in Nancy. That's V Papyan at squarmilner.com.
Great. Ron, why don't you go ahead, because you were such an integral part of this episode, go ahead and give your contact info too. Go ahead.
My website, rate.com/Ron Bruno. My email address is ron.bruno@rate.com, and I can be reached at 310-804-8243.
Great. Well, thanks so much, guys. Really fantastic. And if you have other questions, we can definitely get in touch with Vahan and Steve, and ask for you. So please don't hesitate to leave a comment or a question for us on our Facebook page, facebook.com/Clarified Realty Podcast, all one word. You can even email me directly at tom@clarifiedrealty.com. For more exclusive bonus content and advice between episodes, please check out our website, www.clarifiedrealty.com. I'm on Snapchat, Twitter, and Instagram as well. My handle for all three of those are @ClarifiedRealty. I beg you guys, come on now, please, come on, leave that feedback and reviews on iTunes or in the comments section on our page. My amazing theme song, Hey Now, is from the band Wolf. That's Wolf with 2 Fs, and please go check them out and like them on SoundCloud. We'll also leave a link to the song in the credits if we can. They rock so hard, I think I may have found the answer to the meaning of life. No, seriously, they're that good. And just a little disclaimer, Ron and I are licensed by the California Bureau of Real Estate. My license number is 01715353. Ron's is
Guaranteed rate, NMLS ID 2611, NMLS ID 558706, California.
The advice we give is only for properties located in the state of California. For all other states, please contact your local real estate agent or real estate professional. And that's about it. Ron, you good?
Fantastic.
Fantastic. All right. Well, thanks for coming, everybody. And remember, the greatest thing you can ever do is make someone feel at home. Take care. We'll see you next week.
What you gonna do with your